Hey guys, Stock Saturday, and I made quite some drastic-ish changes, I suppose, this week. It's been a little bit red, down about 4,000, a couple of percent, so I'm underperforming the main markets, S&P, Nasdaq, and FTSE. So that's not the best, but carry on. So I'll just sort of go through the changes quickly. You notice my cash is down to £1,000. I've been sort of thinking April is coming, so I would have to sort of move something into the ISA anyway, and I sort of thought might as well do it now. So I've moved pretty much all of that into the ISA and maxed out the 20,000, and I've put all of the cash into 3-year US Treasuries. So this isn't sort of me suddenly getting into bonds. This was more just trying to find something as close to sort of bank account cash really as I could. Was getting a little bit annoyed really with having sort of 12, 13,000 pound sitting there earning zero. I don't sort of really want to be too heavy cash at the moment, but I don't mind being sort of cash earning 4 or 5%. But cash earning zero is not sort of very good at all. So I thought put it into 3-year treasuries, put it into this iShares bond. It's a bond ETF of 1 to 3 year bonds. So they're sort of quite short duration. Obviously, within the fund, they constantly roll them into new sort of 1 year. Every year they'll they'll mature, they'll get the money back, and they'll buy a new one. So it's constantly sort of 1 to 3 years churning over, basically. And I've gone for the Great British Pounds hedged version. So a lot of people sort of, certainly in Discord and things, sort of get the impression that simply having something in pounds is sort of avoiding the currency risk, which is not really the case. The hedged versions actually use sort of derivatives and sort of shorts and longs of the currency to basically remove any risk of the pound dollar ratio going up or down. Whereas sort of you can have this fund as an ordinary US dollar version, or there's other versions of bond funds that might be in pounds, but it's not actually removing any of the risk. It's just converted into pounds at all times, where this is actually sort of removing that risk through derivatives. It adds a very, very slight amount to the expense ratio, but I thought that was worth it just to sort of avoid any currency risk. And yeah, the sort of current interest rate is sort of 4.3% or so. So I'm sort of kind of expecting interest rates to be pretty much topping out at the moment. And yeah, if we do get any sort of hint of a pivot, even really just a pause, but sort of potentially a pivot with something going wrong, then I would expect this to sort of perform reasonably well. And sort of the longer term bond funds would do better, but I didn't really want to sort of take that risk. This was supposed to be as close to cash as I could, but earning sort of 3 or 4%. So we'll see how that goes. As I say, I'm not suddenly getting into bonds. This could just be sort of for 2 or 3 months. If I could have put it sort of in the bank relatively easy and then reinvested it when I wanted to, then I'd have probably done that, but it was just too much work. So yeah, that's sort of the big change for this week. So looking at some results, we've had Hymax. A lot of my companies do sort of report later than all the big techs and that sort of thing. So Hymax Technologies, one of my sort of bigger positions, actually sort of beat earnings estimates quite handily, but they are forecasting again a bit of a rough quarter Q1 this year. So the sort of middle of the quarter we're in now. They do sort of keep not doing too bad, but then saying next quarter is the bottom. I think they were sort of saying Q3 last year was going to be the bottom, and then Q4, and now next quarter. But overall, still seems pretty good. Automotive side doing really well, and is sort of basically the biggest market now. So every car has a load of sort of tablets and screens and heads-up displays, sort of less so the heads-up displays, that's more on sort of the luxury side, but does seem to be where everything's going at the moment. So just coming down to the financial statements, the revenue was a little bit better than Q3 actually, obviously a lot worse than this quarter last year in 2021, but that's to be expected. It was sort of an anomaly year really, but we're hoping to get back there. Costs down, and sort of operating income quite significantly up. So yeah, potentially Q3 might have actually been the bottom. We're just still sort of having a rough time, and Q1 could be a little bit rough as well, but all looking fairly good. So profit attributable to holders, $42 million, up from $8 million in previous quarter, but again down from 142 million in the previous year. Coming down to the balance sheet, there's not all that much change really. Cash almost exactly the same as previous quarter, ever so slightly up. Inventories down, which is good. They're sort of saying that's improving and sort of should improve over the next couple of quarters. They don't want to have inventory stacked up. The debt is still there, unfortunately. The short-term borrowings, that's not changed at all, up from last year quite significantly. And yeah, sort of balance sheet hasn't really changed too much overall, as I say. So potentially Q3 was the bottom, and we're sort of looking reasonably good. Still sort of think it's got a long way to go over the next sort of couple of years if the automotive section can sort of push on, and the rest of the sort of legacy sectors, I suppose, carry on. Potential as well for sort of the VR side to kick off if people want to be buying headsets and that sort of thing, and AR headsets. The Apple one sort of coming soon. I doubt they would be using HiMax. They probably sort of utilise their own thing, but Apple could be sort of popularising the headsets, and then sort of other manufacturers maybe using HiMax. So that was good. A few drops sort of here and there in the portfolio this week, one of which was Google, or Alphabet. So it's not a particularly big position for me, and I've sort of always struggled to increase that position. A lot of people sort of wondering why I don't really up that. It's got reasonable sort of forward PE, decent balance sheet, and sort of great profit margins and that sort of thing. I just sort of always struggle with companies of this size, you know, well over $1 trillion. It was sort of well over $1 trillion before, sort of last year, back when we were sort of in the 140s, pushing, you know, 1.75 trillion. And yeah, I just sort of don't really like the way they run some of their sort of smaller ventures and that sort of thing. They seem to start a lot of things and just scrap it, even when they are popular. Stadia, in particular, sort of wasn't something that I was looking to use really straight away, but if I'd have got a PC, might have been quite nice. And sort of a lot of people thought that was a pretty decent service. They were buying games and that sort of thing, buying the controller and subscribing, and then they just sort of scrapped it. From what I understand, they did basically refund pretty much everything that anybody bought, games included. So you might have played a game, completed it, and then they're giving you a full refund. So they can't have sort of been much fairer on people, but it's just irritating. Some people might have bought a PC with sort of the sole intention of using Stadia, and then they just scrap it, and sort of various other things, Google Glass, Google Plus, the social media thing. Not things that I would sort of be keen to use, but it's just seems a little bit strange for them to sort of start things up and just scrap it. And they, from what I've seen, they've been sort of laying people off, and they do seem to waste rather a lot of money. Some of the people they've been laying off, sort of masseuses and sort of people who restring the table tennis table for their afternoon sort of bit of fun. All seems a little bit too lax. I'm not saying you've got to be an organ grinder, but sort of playing table tennis for an hour or so in the afternoon and then having a massage, when they're saying the average salary is like $250,000, kind of think sort of, have a bit of a break, but generally sort of get back to work. Maybe that's a bit harsh, but there you go. We've had miners having a bit of a rough time of it. Copper sort of coming down off sort of recent highs, but obviously sort of still doing well off the October bottom. But just coming off a little, $4 on copper. Iron ore sort of not really coming down, sort of slightly off the top, but doesn't look too bad. The sort of copper and the sort of industrial metal miners haven't been doing quite so well. And the silver miners, I do have First Majestic and Pan American Silver, and they've sort of taken a bit of a hit recently with the sort of drop to $22 silver, which is quite close to most of their sort of production cost, all-in sustaining cost. I think Pan American sort of in the 17s, and First Majestic I think is sort of between 17 and 19. I think sort of recently it's come down to 17, but so at 22 they're not exactly making a huge amount. I don't even think that all-in sustaining cost is sort of all of their costs. That it doesn't quite include all your share-based compensation from office staff and that sort of thing. It is just the full cost of everything to mine. So $22, they're sort of not going to be making a great deal, but I'm still pretty bullish on silver long term. So potentially thinking about sort of topping up. I may just buy some physical silver, to be honest, but was kind of tempted to maybe buy a little bit of the miners. Still got sort of 5,000 or so cash in the bank, waiting to sort of. I was thinking wait to buy the crypto dip, but we'll see if we do get an opportunity for that. If not, I was kind of thinking of maybe putting in some silver miners. And speaking of silver, Silvergate Capital, that's a segue, isn't it? Silvergate Capital down 24% for the week. Still sort of more news revelations to come out, whether they're going to get sued for the FTX scandal and that sort of thing. Not looking all that good. There's sort of very little news of customers coming back in a significant way. Not sort of seen any updates from them, but they did get a bit of a pump from BlackRock taking a position, which was interesting. I kind of saw that as maybe some inside knowledge, or could just be a bet basically from BlackRock. They do sort of obviously have a very large amount of capital, so they can afford to make sort of small bets on companies like this, and maybe they would just sell them. Sort of rallied on that news. They have sort of released their earnings a couple of weeks ago, I think, and they sort of release with the other banks. So most banks do go quite early, even if they are a crypto bank, they still sort of go with the rest of them. And you sort of look at their previous few quarters. I do like the way they sort of lay this out with the sort of previous 4 quarters and December last year. So I wish more companies would do this, but yeah, interest earning deposits in other banks are sort of up significantly, but total assets has come down, sort of kind of expected, and you see the non-interest bearing demand accounts, this was sort of reported before, coming down from 12 billion to 3.8. That's sort of the bread and butter, really. The sort of Send network deposits, that's come right down, but really you've got to be looking at sort of whether they're going to come back, and also whether there's going to be any ramifications from the lawsuit. But yeah, anything sort of that they have got in deposits is sort of earning a decent wedge now with treasuries, sort of where they are. If I'm earning, 4% or so on a small amount, then them earning, 4% or more on 3.8 billion is pretty good for, a 476 million market cap. If they can get sort of anywhere close to what they were earning, then this is a decent business, I think. And with sort of competitors getting out of the market, yeah, not sure whether sort of the big players would muscle in on this sort of business, or whether they would just buy Silvergate, for $500 million. Probably seems easier to just buy them, really. Maybe a little bit of premium on top of that. It would sort of capitalise. I guess it'd probably see me at break even, really. I think I'm at about $19, including sort of FX change. So yeah, it's not been the best buy. It pains me to sort of look at Argo blockchain now, which was what I sold to buy this. But yeah, you live and learn. I don't want Argo, so there you go. So that's the portfolio, really. As I say, sort of some losers, sort of in the mining sectors, not been going so well, and sort of on the rest of the invest account, sort of big tech, meta platforms not doing all that well. Process sort of taken slight knock, but still doing reasonably well. Stellantis was sort of holding its own. TSMC holding its own as well, with sort of semiconductors not doing all that well. So yeah, I was pretty happy overall. We'll see a couple of my others sort of reporting in the next couple of weeks, and yeah, I'll report back, and sort of be interesting to see how long I want to hold this treasuries for, and if I want to sort of buy the dip on anything. So let me know your thoughts on the sort of treasuries plan, and sort of what else you'd be looking to buy. I should mention as well, I've not been updating when I've been sort of moving stocks around. I've not been updating the sectors, so the pie charts have been sort of quite a bit off from the actual portfolio for the last few weeks. So if you're sort of interested to see where things currently are, these pies are now accurate. So 28.6% semiconductors. That's interesting. Hadn't sort of realised I was quite that heavy. I guess this is sort of Himax and TSMC pumping up those numbers. Still got Micron as well. Kind of tempted to sort of maybe get rid of Micron and push that elsewhere. Maybe even up Himax. But yeah, we'll see. So leave your thoughts in comments below, and like and subscribe. See you soon.